Hey, it is 12 noon on Wednesday, which means it's time for another episode of Ask the Instructor. I'm John Chrismo. Every Wednesday, 12 noon Eastern time, we come to you to help you get a better understanding of the technical side of the real estate industry, maybe help you study for your real estate exams, or really just help gain your knowledge. We're talking about mortgage amortization today, mortgage amortization, and how to calculate mortgage amortization, which this is basically figuring out the breakup and the makeup of the amount that goes towards interest and the amount that goes towards principal on your loan. We'll also factor in the impound account for taxes and insurance and show you how to calculate that to really get a full understanding of your mortgage payment. So that way, if you see this on your exam, you know how to answer it. Or if you see this in your real world where your clients come to you and for whatever reason they don't want to talk to the loan officer, maybe it's because they trust you better. Hey, don't send them to the person they don't trust. That's just going to tarnish your relationship. Give them the little bit of knowledge it is that you have about amortization, which hopefully you'll be able to pick up today. We got a great show for you guys today. Stick with us. I'm John Chrismo. You're watching Ask the Instructor.
You are watching
Ask the Instructor. Every Wednesday at 12 noon Eastern time. I'm John Chrismo. You're watching Ask the Instructor. Hey, it is 12 noon on Wednesday, which means it's time for Ask the Instructor. I'm John Chrismo, and on behalf of the Tampa School of Real Estate, we come to you live every single week, almost for a year now. We've got our special one-year anniversary show coming up next week, next Wednesday, so make sure you guys don't miss that. But what we've been doing for the past year, or almost the past year, is coming to you live every Wednesday at 12 noon Eastern Time to help you get a better understanding of the technical side of the real estate industry, whether that's like what we're going to be doing today, calculations and getting to understand numbers. And real estate is very much a numbers industry, and a lot of people get freaked out when they start seeing numbers or get worried that they're going to not understand these numbers, or they just shut down because they don't know the numbers, and that shouldn't be the case at all. They're just numbers. They're more trustworthy than anything else. So we've got a lot of episodes about dealing with the numbers. We've got episodes about planning for your business. We also got State of Real Estate. We've been coming up on 1 year for that as well, where we help mastermind and grow your real estate business. Now we've got a lot of videos, a year, that's 52 weeks. So, and we've been doing these every week. So there's over 50 videos you'll be able to find all at tampaschool.com/success. Again, that URL is tampaschool.com/success. Make sure you write that down and check it out after the show. You've got all of our previous episodes of Ask the Instructor, as well as State of Real Estate, as well as a lot of articles, as well as interactive calculators like our business plan calculator, and all kinds of tools to help you plan for your success. So again, that website is tampaschool.com/success. SUCCESS, all lowercase in that. But anyways, so that's the best place to check that all out. Make sure you drop your email in there, and that way we'll notify you via email whenever it is that we do go live, so you don't miss out on any of these episodes because they are live. You can chat in, you can ask us questions. If you're a past student, if you're a current student, or you're going to be a future student, hey, look, even if you haven't enrolled yet, if you're going to be a future student with us, we know you will be. You wouldn't be watching these videos otherwise. So definitely let us know what questions you have, what we can help you with, even if you're watching one of these recordings of the live streams. If there's something you didn't quite understand or anything like that, let us know. We'd love to help you. We'd love to make a whole episode based around your question, if it's a good enough question. So make sure you send in those questions to us, whether it's through the chat, through our text messages, through over the phone, through email, however it is. Get in contact with us. We'd love to help you guys out and get a better understanding of the real estate industry. Now let's get on to the topic of the day, which is mortgage amortization, or how to amortize a mortgage. And this is something really everyone, not just real estate professionals, but also homeowners or people that are considering being a homeowner, or people not considering being a homeowner, should understand amortization so they really get a better understanding of how to make the right decisions for them. Now, the problem is most people don't understand amortization, have no intention to understand amortization, but they trust us as real estate professionals, whether you're a real estate agent, or maybe you're a loan officer, or maybe you're a broker, or maybe you're just somehow tied into the real estate industry, well, people will maybe ask you these questions. So let's start off with just some of the basics of amortization so you get a better understanding of how this works, and then we'll work into the calculations, because once you understand the simple part of how this all works out, the calculations make a lot more sense. So basically what we've got here, we'll put a little number line, high dollar amount, low dollar amount, fill in whatever numbers it is that you want. We'll do two different numbers here, or two different colors for our two different parts of our mortgage payment: interest and principal. The interest, this is the money that we never see again. Actually, you do see it come back to you on your taxes, currently under the current tax code. And even with the proposed adjustments it is that they're making, they're just talking about lowering the ceiling down. I think it's down to like $500,000 is the highest amount of loan it is that you'll be able to deduct interest for, which, I mean, it's not the end of the world. It's not going to make it where people don't want to buy homes. Yeah, people might be a little bit more hesitant about buying a home where they're taking out a loan over $500,000, but for the majority of homeowners, it won't affect them with that. So even with, if that even goes through with what they're talking about doing with the new tax code and everything like that, or how or tax reform, or whatever it is that they're calling it, look, it's not going to turn the business upside down. They wouldn't. Very rarely do they ever do something that turns something upside down. And even when you think it's going to turn something upside down, it's usually not the end of the world. So we've got our interest, and this is the money goes to the bank, goes in their pocket. We don't see that money again except for as a tax deduction as a homeowner. That's a great thing to know as well as a real estate professional, is that interest payment it is that you're making. And we're going to find out that this red is going to be a lot higher in our first few months than the green, the principal portion of this. But this red portion, this is tax deductible. Now, the way this works out, so we've got our dollar line laid out here, and then we'll also do time. Let's say 0 years out to 30 years. So something roughly like that. And we'll throw one more color in here, the blue. This is going to be the total mortgage payment. So our total mortgage payment, most mortgages, it doesn't change. Unless you have some sort of adjustable rate mortgage or something like that with a standard level payment plan, amortized mortgage, which is typically what most mortgages are, your payment amount stays the same. You're paying $1,000 a month, or $1,547.39 per month, or whatever that amount is. That payment amount stays the same. Now, moving now into the composition, because we're not talking about finding the payment amount with amortization. We're talking about understanding the composition. How much is interest? How much is principal paying down your loan balance? And the way this works out, and roughly here, that this is what you're looking at, you've usually got, for the first few years, it's almost all interest. So this whole portion of your payment is interest. Now, as time goes on, the interest amount decreases, but again, you're paying the same payment amount the entire time. So that's where our principal comes in. And you'll see your first few payments, very little principal being paid. But as you pay down and decrease your balance, the amount that you're decreasing the principal is going to increase, and your interest is going to decrease. Again, it's the same level payment. You're paying, let's keep it simple here. Let's just say it's $1,000 a month. So $1,000 a month. 15 years in, still $1,000 a month. 30 years, your last payment is still $1,000 a month. And now we'll throw some rough numbers in here just so you get an idea of this here. Maybe for your first payment, we're looking at $990 in interest, which leaves us with, $10 in principal. But now as time goes on, let's say we're about halfway through this year, at about 15 years in, and now at this point, our interest payment, let's say our interest is, let's roughly guess this here, we'll say it's about $600. And our principal payment is, let's say, about $400. So you see how that changes and grows, and when we do the calculations, it'll make a little bit more sense why. But as you go down and decrease, and now when you get down to close to 30 years, let's say on our final payment, we might have $10 of interest and $990 in principal being paid. So that's the way the interest works out. And what's happening and why this interest is decreasing is because your principal balance, your loan amount, the amount it is that the loan is issued for, is highest at the beginning of the loan. When that loan is first made, that's when the loan amount is the highest. But now that first payment, you're only decreasing it by $10, but it is a small decrease. So this becomes maybe $989, and this becomes $11. And the following month, maybe $987, and then it's maybe $13. So it's gradually getting the interest. The interest is really what's steering this and driving this factor, what's making this all what it is, because the interest is calculated based off of how much money you owe. So the faster it is that you decrease the amount it is that you owe, the lower the interest is going to be, the less dollar amount it is that you have in interest. The interest rate, assuming we've got a level payment plan, fixed rate mortgage like we're talking about here, a very standard type of mortgage, with that rate staying the same and our principal amount decreasing, that's only going to mean that our interest is going to go down. And since we're paying the same amount, as our interest goes down, our principal amount is going to increase and increase and increase. And the more it's increasing, that's why you start to see this drastic slope really pulling us down a lot faster as we get close to that 30-year mark. Now, where the banks typically win is most people are going to sell their home right here in about 5 to 7 years after owning the home. They go sell it, they go take out a new mortgage. Or if you refinance, you've basically reset this down to zero now, where your principal is again very small, and so on and so forth. And not the end of the world, because remember, this interest, that's the deductible stuff. This is the stuff that we're able to deduct from our income taxes to help offset our income. Make sure you talk to your accountant about this, about doing this in the real world. But this is a very real benefit. And even after the whole proposed legislation right now, it's just lowering the cap of $1 million loan down to a $500,000 loan for the interest to be tax deductible. And who knows if that'll even go through. But even if it does, if you're dealing with a loan that's less than $500,000, it's not affecting you. It's not affecting your deductibility for that as the way it looks like that might go through now, if that even does go through what they've proposed for right now. So don't worry about that. Don't worry about that changing the real estate industry. It'll have a very small, if any, effect, because the people taking out loans over $500,000, they're probably not doing it solely for the interest deduction. Yeah, it's a nice benefit, but you know, it's not the one key reason always and every time. So that's our amortization of generally how this works out. Now, when we're looking at this here, we're assuming that we're just looking at two things. The interest, which is what we've got here in red, and the principal, which is what we've got here in green. So those are the only two items. But now, on top of that, you might have a few other items that are also being part of your mortgage payment, which are typically your property taxes and your hazard insurance on the home, the homeowner's insurance. So those will be added in on top of that. And that's what I want you to work out first, because that's actually going to be a little bit easier math than the amortization. The amortization by no means is difficult math, and this is something very likely to show up on your real estate exam. So if you're watching these videos to study for your exams, this is a really good topic that you want to know, because it's very, 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 if not almost guaranteed, very likely to be on your exams for mortgage amortization. So definitely a hot topic that likes to get asked about, and it might even complicate it further like we're about to do here, where we're going to be dealing with the property taxes and also insurance and how that factors in as part of an impound account. It's really not that difficult. It's really not that tricky. But before we do any of that, we're going to take a commercial break, so stick with us. I'm John Carissimo. The show is brought to you by the Tampa School of Real Estate, and that show is Ask the Instructor. Back in listen.
Do you want to incorporate studying for your real estate exams into your busy schedule? Now you can review the key topics you need to know to pass your class and state exams with our MP3 audio review. Simply pop in your headphones or connect to your car to reinforce crucial information while you exercise or drive. Listen to the first unit for free at mp3audioreview.com. That's mp3audioreview.com. Does your current career allow for unlimited income potential? With a career in real estate, the sky is the limit. What you put in is what you get out. Find out more about how you can tap into the unlimited income potential of a career in real estate at tampaschool.com.
Hey, if you're enjoying the show today, which I'm sure you are, be sure to hit like, subscribe, post your comments, share with your friends and family. Thank you guys so much for watching.
You are watching
Ask the Instructor. Every Wednesday at 12 noon Eastern Time. I'm John Chrismo. You're watching Ask the Instructor. Hey, welcome back to this week's episode of Ask the Instructor. I'm John Chrismo, and this show is brought to you by the Tampa School of Real Estate. Every Wednesday at 12 noon Eastern Time, we come to you live to our previous students, to our current students, and to our future students to help you get a better understanding of technical topics like amortizing a mortgage and understanding these calculations. Now, what we went through before we went on this first break, and if you guys are just tuning in, you missed this beginning part of that, that's okay. Write down this link. It's tampaschool.com/success. Again, that's tampaschool.com/success. You'll be able to go in and rewatch this entire episode as well as all kinds of previous episodes of Ask the Instructor. But really, everything we just talked about here, this is the bare minimum knowledge. We haven't even talked about any calculations yet. And look, I get it. I know there's a lot of amortization calculators out there. And when I'm actually looking for a breakdown of amortization, I'm going to use the amortization calculator. I'm not going to sit there for a half hour and do 360, really 900 different calculations to find out what every single month, every single year is going to be in interest versus principal. Now, on your exam, you don't always have that luxury of being able to Google an amortization calculator, but even in the real world, when you're using those amortization calculators, it really helps you a lot when you understand how those numbers are being came up with. You don't have to go through the difficult process of running every single one of those computations, but when you know what the computer's doing to make those computations, those numbers all of a sudden are so much clearer to you. But on your exam, you will have to probably do this for probably at least 2 months, if not 3 months, you'll need to be able to amortize out. Now, the good news is if you could do 1 month, you could do 2 months, you could do 3 months, you could do 360 months. It's just a matter of how long it's going to take you to do these calculations. But before we get into the actual amortization calculations here, I want to go ahead and break down the impound account stuff. So when we're talking about the taxes and insurance that are also being paid as part of the mortgage payments, what that actually looks like and how that factors into this calculation. Because with amortization, you're only going to be dealing with, or you only need to be dealing with, you only should be dealing with just the principal and interest. You shouldn't be dealing with anything else when you're doing amortization calculations. So what that means is if there is an impound account where taxes and insurance are being charged on top of that, you need to take that out and work with that separately. So how are property taxes charged? Property taxes are charged on an annual basis. Let's say that our property taxes are $1,200 a year. Now, why did I pick $1,200 a year? Because it's a nice, easy number. We don't need a calculator to do any of the calculations there. What that breaks down to is our property taxes per month are going to be $100 a month. So in case your question or your real world scenario that you're dealing with includes, your mortgage payment is including the property taxes, it's very simple to extract that information. You're just going to take whatever the annual rate of property taxes are, in this case $1,200, divide that by 12, and that's going to yield what your monthly rate is, $100 a month. And now this just gets added on top of whatever your principal and interest payment is. You'd have your principal and interest plus the $100 a month for property taxes, but if you're making you do property taxes and in a pound count, they're also probably making you do hazard insurance, the homeowner's insurance. And let's say that our insurance premiums are, they might give this to you per 6-month basis. That's typically how these are quoted in the real world, why they choose 6 months instead of just a year. Who knows? Sometimes they're quoted in a year. You just got to pay attention to what it says per year, per month, or whatever it is. Very easy to work with those when you know what it is that you're dealing with here. But let's say that these are $300 for 6 months. which means our year is $600. Because we just double that. 300 for 6 months is 600 for a year. And then we just, again, divide that out by 12, and that would give us insurance for $50 a month. So our additional items that would be added in as part of our mortgage payment would be our $100 a month for property taxes and our $50 a month for insurance. That's all the math is for that there. It's really nothing difficult, nothing complex. It's just a matter of taking the total annual bill of property taxes or insurance, and if there ever is anything else they're making you pay on top of that, it would basically be the same calculation, just taking that dollar amount for the annual rate, dividing it by 12, and you've got your monthly rate. And yes, if you're looking for shortcuts here, you could have took $300 and divided it by 6. That also would have done it as well. Usually when you see like this, the little slash here, that means you could divide. Or if you see where it says 300 per 6 months, per also means you could divide. Per is synonymous really for a division sign. So you could do that as well. 300 divided by 6 is still $50. So there's a lot of different ways to come up with the answer for this year. Just use whichever way makes the most sense for you. And the one tip I always give whenever you're practicing these math problems or anything like that is find one method that you like and then master that one method. Don't try to learn 27 different methods of how to solve a question because you won't remember a single one. But if you practice that same one method 27 times, you're going to have a hard time forgetting it. So focus on one type of method. Now, so this is our additional amounts. So let's say our payment is... let's say our mortgage payment is $1,350 a month. Our mortgage payment is $1,350 per month, and it includes impound for our $1,200 a year property taxes and our $300 for every 6 months of insurance. What now is our principal and interest portion of this? So what we would do is just subtract out, okay, for our insurance, we would do, okay, $1,200 divided by 12, that gives us $100 a month. So we would subtract $100 out of this year, and that's for our taxes. And then we're down to $1,250. But then we also need to subtract out also the $50 for our insurance. So if you're working with an amortization question, you always need to make sure that you take these out before you start dealing with any amortization stuff, because the taxes and the insurance does not get amortized. It does not get factored in the calculation. This is just extra money that they collect that sits in an escrow account into an impound account where it's set aside, and when property taxes have to be paid, there should be $1,200 in there to pay the property taxes. When the insurance has to be paid every 6 months, there should be $300 in there to pay the insurance. And the reason why lenders typically require taxes and insurance to be paid as part of the mortgage payment is because they want to make sure that the property doesn't get lost to a property tax auction. Because you want to remember, property taxes are the number one most superior, most important, most high priority lien. It doesn't matter when property tax liens are filed, they automatically become the number one priority in any chain of liens. So it automatically gets to cut the line and go first against all the other liens. So what that means to a mortgage lender is if it gets lost to property taxes, that's not good for them. That means that they're probably going to lose out on the ability to foreclose on that property if it's sold off as property taxes. Now, the insurance is the same thing. A lot of lenders will also require you to pay your insurance, your hazard insurance, your homeowner's insurance, also maybe if there's flood insurance or anything like that, whatever type of insurances are necessary to protect the property effectively, they'll require you to pay that a lot of times as part of your mortgage payment as well. And the reason why they'll do that is because, so typically, most properties, a majority of the value is coming from the building, from the structure itself. Now, that's not always true. You might have this prime piece of 1 acre. I actually got an email the other day from some agent that has got a property that they're trying to sell that it's like 1.5 acres right on the beach of this prime waterfront property, and the house on it looks like a tool shed, for lack of a better term. And that would be a scenario where that's not the case, where the land is definitely a lot more valuable than the actual building itself. But in most cases, most circumstances, and somebody buying that property is probably going to go, because I think it was offered for sale like something like $4 million. So I think they're going to go and actually put a larger, bigger, better house on that property. to make it more fit the norm of, okay, we've got this lot that's worth $3 million and now there's a $9 million house built on top of it or something ridiculous like that. But typically with most properties, the building is going to make up a majority of the value, typically anywhere from 80 to 90%, especially you get into more suburban areas where the land isn't that valuable, but there's still really nice houses on top of them. That's where it might be even higher, where the building makes up almost the entire value of this. So going back to why the lender requires you to pay insurance as part of the mortgage payments in a lot of cases is because if that building gets destroyed, if a hurricane comes through, if a flood comes through, if there's a fire, if there's some sort of natural disaster that destroys the building, the banks are left empty-handed. Because if your house burns down and you don't have insurance on it, you're probably not going to still be making your mortgage payments like a good homeowner. Now, so what would they typically do when you don't make your mortgage payments? They'd foreclose on the property, which they still could foreclose on the land and the charred embers that remain of the property if it burnt down, or the pile of rubble if it was knocked down by a tornado or a hurricane or anything like that. They could foreclose on that, but it's not very valuable. It's probably not even worth the going through the foreclosure. So the lenders will typically require insurance payments. If they don't think that you're going to be making the payments on their own, if there's any doubt that they have, and the lenders in this day and age are very doubtful about everything, and that's just because they learn maybe not to always trust people for what it is that they say. So they require the insurance to be paid as part of the mortgage payment. So that way, if there is some natural disaster, something happens that destroys the building, which makes up a majority of the value of the property, that there's an insurance policy in place to cover that. So that's why these items are typically paid, so the lender doesn't lose out on their interest due to this going to a property tax auction, or that they lose out on this because the property is destroyed due to some sort of natural disaster, whatever that may be. But again, point being is that this does not factor in with the amortization, that this is not part of the principal and interest calculations that we're going to be doing in just a second. So we would subtract that out there, and we'd end up with $1,200 being our principal and interest. $1,200 representing our principal and interest. We started off with our $1,350 monthly payment. We took out the $100 a month for property taxes, which it would have gave to us as $1,200 a year. It took out the $300 for 6 months of insurance, which we figured out to be $50 a month, and that leaves us with $1,200, and that's the amount that we actually need to go through and amortize and break down and figure out, okay, this month this much is going to principal, this much is going to interest. So we're going to continue going deeper down the rabbit hole and working with this principal and interest here, this $1,200, and figuring out, okay, how much of that $1,200 is actually going towards interest, how much of it is going towards the principal, after we take this quick commercial break. So stick with us. I'm John Chrismo. You're watching Ask the Instructor.
Do you want to incorporate studying for your real estate exams into your busy schedule? Now you can review the key topics you need to know to pass your class and state exams with our MP3 audio review. Simply pop in your headphones or connect to your car to reinforce crucial information while you exercise or drive. Listen to the first unit for free at mp3audioreview.com. That's mp3audioreview.com. Does your current career allow for unlimited income potential? With a career in real estate, the sky is the limit. What you put in is what you get out. Find out more about how you can tap into the unlimited income potential of a career in real estate at tampaschool.com.
Hey, if you're enjoying the show today, which I'm sure you are, be sure to hit like, subscribe, post your comments, share with your friends and family. Thank you guys so much for watching.
You are watching
Ask the Instructor. Every Wednesday at 12 noon Eastern Time. I'm John Chrismo. You're watching Ask the Instructor. Hey, welcome back to this week's episode of Ask the Instructor. Every Wednesday at 12 noon Eastern Time, we come to you live to help you mastermind to grow your real estate business, to help you understand the technical side of the real estate industry, to really give you the knowledge it is that you need to be confident, not only on your exam and passing your exam, because look, that just passing your state exam, that just gives you a seat at the table. That just gives you the opportunity now to earn money. It now comes with you serving your clients with that knowledge it is that you've gained, as well as the knowledge it is that you're going to gain in your future. So the more knowledge it is that you have, the more confident you're going to be. When you're confident that you could talk about mortgages, you're not going to shy away when your clients have questions about mortgages. Even if you don't know every last detail, you want to understand the basics and have a base understanding. Really, that's the whole reason why the Florida Real Estate Commission requires you to take the pre-licensing course, because they want you to have a basic understanding of a lot of different aspects of the real estate industry, even the mortgage aspect, which you're not legally able to do mortgage stuff. That has to be done by a mortgage loan originator, a mortgage lender, mortgage broker. But now, why do you have to know about that? Because you are the executive in the transaction. You're the one pulling the pieces together. The word brokering really means to bring together buyers and sellers. That's what you're doing in real estate. You're bringing together buyers and sellers. And in order to bring them together and keep them together, because that's the other part of this as well, because if they fall apart, if their agreement breaks up, if they breach the contract and go their separate ways, you don't end up getting paid anything. So your job is not only to bring them together, but get them to stay together until the closing goes through, to make sure that that property does get transferred. But part of that might be when the buyer's a little skeptical about something, and you being able to answer their questions, to be able to verify what the loan officer is telling them is actually true and is accurate, and this is how things normally go, and reassuring them is going to go a long way to helping keep that transaction together. So although information like this, you may say, oh, what do I need to know that for? The more knowledge it is that you have, the more comfortable and confident you're going to be when your clients ask you questions, especially if it is something like this. And this is very likely to be something you're going to see on your exam, so at the very least, make sure you know it for that. But let's go ahead now and break down the amortization. So we've gone through and we just took out the amounts for our impound account, which is for our property taxes and our insurance. And the reason why we always have to take that out before we do any calculations is we only want to be dealing with the dollar amount of our monthly payment that deals with principal and interest. Now, if you're preparing for your exam and you're planning on seeing this on the exam, what you want to know is you're probably only going to see principal and interest. They might not complicate it to where you also have to deal with the impound account with the taxes and the insurance on top of this, on top of your principal and interest. If you do, you can see it's very easy. You just figure out what that monthly amount is and then subtract it from the total payment, and now you're left with just the principal and interest. But probably your question is just going to start you off with the principal and interest. So our principal and interest portion of our payment is $1,200. And now that's information that's going to be given to you in whole or in part, if you have to go through and break it down like we just did, in your question. So you've got your payment amount of $1,200. And now what you need to do is pull out two other items. These other two items are the APR, the annual percentage rate. Now, even if they just call this an interest rate, you want to remember it as an annual percentage rate. And that's going to be very important when we're solving our question, to remember that this is an annual percentage rate. And let's say in this case here, it's, let's say 5.5%. So we've got an APR of 5.5%. And now finally, we need our loan amount, where they might also call the principal. Principal and loan synonymous. They're the same thing basically. So your loan amount, let's say in this case is, let's say $250,000. So we've got a $250,000 loan, we've got an APR of 5.5%, and we have an interest, a principal and interest payment of $1,200. Now with these three pieces of information, we could find out what every single month, how much goes towards principal and how much goes towards interest. And the way we go about doing that, it's three steps mainly that we're going to be doing. Number one, we're going to be finding the interest. Now, I really love step one here because when I learned how to do this, I learned how to calculate basically any type of interest. Whether this is on a credit card bill, some sort of loan, or really any time interest is charged, It's basically the same calculation as what we do here, and there's one little key part of this puzzle that we add in that makes a lot more sense of this here. It really kind of has to do with this APR, remember, being an annual number. And once we've got that demystified, it's actually really easy to find out what the interest is. So we find the interest in a dollar amount. Because we already got the interest percentage, that's 5.5%. We need to now translate that to a dollar amount. And then what we do is find our principal payment. And that's also a dollar amount. And the way we're doing this basically is we have our principal and interest payment, which remember, we've isolated this down to just being principal and interest. So we've got that $1,200 a month that's principal and interest. We just subtract out the interest dollar amount for that month that we just found. And then your third step, and this is only when you need to know what your ending balance is or the starting balance for the following month is find the new balance. So those are our 3 steps to amortization. And yes, this does seem simple. And you might be saying, no, John, I remember doing this, and this is a lot harder than just those 3 steps. Not really. It's just these 3 steps. Now, yeah, we haven't plugged the numbers into this or done any of this stuff yet, but it's just these 3 steps it is that you have to remember. You have to remember how to find the interest, how to find the principal, which this one's, both of the steps 2 and 3 are really easy. Step 1 is really the most difficult one out of all of them here, and that one's not even that difficult. You're going to laugh when I'm saying this is the most difficult in here when you see this. But it's really good to kind of chunk this and break this up to the 3 parts of what it is that you're doing. Number 1, finding the interest. Number 2, finding the principal payment, how much we decreased our loan balance. And number 3, finding our new balance, our ending balance for this current month and our starting balance for the following month. And then, if you need to go into another month, you're just starting all the way over from the beginning. You're just 1, 2, 3, 1, 2, 3, 1, 2, 3, 1, 2, 3 for as many months as it is that you need to do. On your exam, it's probably just 2 months. Maybe you have to go to 3 months. If you go to 1 month, you can figure out 2 months is 3 months and 4 months, 5 months, 12 months, 360 months. It just takes you a lot longer to do all these steps over and over again. But really, you just need to know what these steps are. So those are the 3 things. Let's start off with number 1, finding the interest. So in order to find the interest, we need these 2 pieces of information, the loan amount and our APR. When we have those 2 pieces of information, find the interest is actually super simple. So what we're going to do, put this in blue here, is take our $250,000 loan balance, that's our loan amount. This is the balance. This is how much we owe for this given month. Maybe this is what we're starting off with. Maybe this is so many months in. But the month that we're doing the calculation for, this is typically starting brand new month 1, is $250,000. Now to find our interest charge for that month, our interest is a calculation. It's basically 5.5% of $250,000, but just 1 month. Remember, that's an annual number. So the math that you're doing here is you're going to multiply this by 5.5%. And the way I recommend doing this is turning this into a decimal, 2 decimal places over. 0.055 would what it would be then. If you know how to use the percentage button in your calculator, go for it. I don't like that button. It doesn't always work. I like good old fashioned way of doing this, but that's up to you however you do that. So 250,000. Now we're going to go ahead and multiply that by 0.0, because we just plug in a 0 there. 5. And remember, that's our APR. This was our loan balance. We've got our loan balance times our annual percentage rate, and then we're always, and this is where most people get stuck on trying to figure out and demystify what that interest is, you're dividing by 12. We're breaking this down, dividing it by the months in a year. Because remember, this is an annual interest rate. So to turn annual to monthly, what do? Well, we did that already. Annual divided by 12 equals monthly. So we take our loan balance of $250,000, we multiply that by 5.5% interest, which is 0.055 as a decimal, and then divide by 12. And you can plug it all in your calculator just like that, one nice, clean, easy swoop. And when we do just that, 250,000 times 0.055 divided by 12, we end up with And let's do this one in red because interest, remember, we're saying is red here. We've got $1,145 and about 83 cents. We could round to dollars and cents here because we're dealing with dollars and cents. So in about 83 cents. That's our interest portion for month one. That's our month one interest. For month number one, how much interest it is that we pay. Now you'll notice here, this doesn't leave us a whole lot of money to pay down our principal. Because if you remember, our total payment was $1,200. We just paid almost $1,200 in interest. And that's how amortization works. So moving on to step 2, now because we just found the interest, that's what one is here. And now for exam questions, they could ask you really any one of these 3 pieces here. They could ask you what was the month 1 interest, the month 2 interest, the month 1 principal, the month 2 principal, or what is the ending balance after 2 months, or anything like that. So step 2, we're finding the principal, how much we've actually decreased our loan amount. Now, in order to do that, our payment, our principal plus interest is $1,200. $1,200 minus interest equals principal. Because remember, it's just 2 parts making up the $1,200, either principal or interest. We just found out what the interest portion is, so what's left over is our principal amount, how much we're going to be decreasing the loan amount. And that's what we're going to do in this next step here. We're going to take our $1,200 payment. We're going to subtract out now that interest number that we just had, the $11.45 and 83 cents. And that's going to give us our principal amount for month number 1. So $1,200 minus $11.45 and 83 cents gives us a whopping, and no, the math isn't wrong here, this is how it works out, $54.17. And that's now our month 1 principal payment. $54.17. So out of the $1,200 that we wrote the check for in that first month, or was withdrawn from our account, or however it goes about, the first $1,145.83 goes to the bank. The remaining $54.17 that we still have on there is what pays down our loan balance. And now for our third step, because we're not done yet, and really we're going to go out to 2 months here to find out, okay, what is this after 2 months? So now what we're going to do to find our new loan balance, well, we start with our starting balance. Our starting balance for the month was $250,000. That was our starting balance. We're now going to subtract from that our $54.17 that we just paid this down. And that's going to equal our new balance for month 2, our ending balance for month 1, the new balance for month 2. So we're just going to punch in $250,000 minus $54.17, a very small chink in the armor here of that outstanding balance it is that we have. And then our new balance is going to be $249,945.83, and that's our new/ending balance. So to recap what it is that we've done here. We started off with a $250,000 loan balance. Now for month 1, we just went and calculated out, okay, how much is our interest first and foremost? We've got 5.5% interest. 0.055 is the decimal. We divide that by 12, and our month 1 interest is $1,145.83. We then subtract that interest payment from our principal and interest payment, the $1,200, so $1,200 minus $11.45 and 83 cents, and we get $54.17 being our principal payment. We now take our starting balance, that we started off with, $250,000, and we're going to subtract how much we just paid down our principal balance, $54.17, and that's going to give us our new ending balance, our balance for the end of this month, really what's starting off month number 2, of $249,945.83. And that's how amortization works. Now, as this is going to go on and progress further, we're going to be decreasing this number more. This dollar amount is going to rise, and that dollar amount is going to decrease. So we're going to go through and do one more month of calculations in this same example, the same one we've been working with here, extending this out another month to see, okay, for month number 2, what's our interest payment, what's our principal payment, and what's our ending balance for month number 2. So stick with us. We're going to take a quick commercial break. We'll be back in less than 2 minutes to finish up this problem. I'm John Chrismo. You're watching Ask the Instructor.
Do you want to incorporate studying for your real estate exams into your busy schedule? Now you can review the key topics you need to know to pass your class and state exams with our MP3 audio review. Simply pop in your headphones or connect to your car to reinforce crucial information while you exercise or drive. Listen to the first unit for free at mp3audioreview.com. That's mp3audioreview.com. Does your current career allow for unlimited income potential? With a career in real estate, the sky is the limit. What you put in is what you get out. Find out more about how you can tap into the unlimited income potential of a career in real estate at tampaschool.com.
Hey, if you're enjoying the show today, which I'm sure you are, be sure to hit like, subscribe, post your comments, share with your friends and family. Thank you guys so much for watching.
You are watching
Ask the Instructor. Every Wednesday at 12 noon Eastern Time. I'm John Chrismo. You're watching Ask the Instructor. Hey, welcome back to this week's episode of Ask the Instructor. I'm John Chrismo. The show is brought to you by the Tampa School of Real Estate. If you're interested in starting or enhancing your real estate career, make sure you give us a call. The phone number is right below, 813-928-0106. Again, that's 813-928-0106. You could call us, you could text us, you could email us. We've got advisors standing by to answer any questions it is that you have and assist you in any way it is that we can. So again, that number is 813-928-0106. Or maybe you want to go and do some of your own research on your own before you give us a call. Check us out at tampaschool.com. Again, that's tampaschool.com. You'll also see that link in the little bar below. We've got all kinds of great information on there, and our little hidden gem is our Success Center. You'll be able to find that under the Resources tab at the top. You'll see Success Center, or you can just simply go to tampaschool.com/success. You'll be able to see all the previous episodes of Ask the Instructor, all of our previous episodes of State of Real Estate, and you'll also be able to drop your email in. Even if you're not a student of ours, you can put your email in there, and we'll notify whenever it is that we go live to talk about these topics. It'll maybe help you prepare for your exam. That'll help you understand stuff a little bit better for the real world, to understand, okay, what's going on with mortgage amortization, so you can explain to your client. Now, why is it important? Let me stop right here and just recap kind of what we talked about at the beginning of the show. Why is amortizing a mortgage? Why is this math? That you'll probably never do this math in your real estate career. And even if you do, you'll go Google an amortization calculator and it'll spit out all these numbers in the blink of an eye. So why do you want to know how these are calculated? Well, you want to understand the process of how this is being came up with here. And this number is a very important number to know for somebody who's entering into home ownership, because this dollar amount is tax deductible. If this is your primary residence, or even if this is an investment property, almost always interest is going to be tax deductible. So this dollar amount, though, that big portion, that $1,200, how much of your rent can you deduct for your primary residence? Nothing. You can't deduct your rent. Not for your primary residence. Maybe for an office or some sort of business or anything like that. But for the place it is that you live, that you call home, if you're paying $1,200 in rent, that's not deductible. You're just paying $1,200 in rent, and that's just going in your pocket and out. And you're using after-tax dollars to pay that $1,200. Now, when you use your after-tax dollars to pay your mortgage payment on your primary residence, and you're paying $1,200 a month, in this scenario here with a $250,000 loan with a 5.5% interest rate with a $1,200 monthly payment, which this is a typical type of scenario. Maybe your interest rate's a little bit lower than that. Interest rates tend to be a little bit lower than this in this current rate, but I mean, maybe 5%, maybe 4.5%, maybe 4% if you've got excellent credit. But that's still going to be a huge dollar amount that's tax deductible. Here, almost your entire mortgage payment is tax deductible. Now, that doesn't last forever. That's going to decrease over time. And I'm not talking about tax legislation or anything like that. I'm just talking about as you pay your mortgage payment, that's going to decrease over time. So let's find out what happens in month number 2. In month number 2, in order to find out month number 2 of amortization, we're basically doing these same calculations all over again. The one difference is we're starting with our new balance. We're not starting with our initial balance. Our balance is no longer $250,000. In month number 1, you get a bill for $250,000 that says you owe $1,200. And maybe if it's a descriptive bill, maybe it is, it probably isn't, it'll even give you these numbers here and show you how much is going towards principal and how much is going towards interest. Or even if it does say that in there, it's probably hidden somewhere where no one ever sees it or reads it. Now, when you get bill for month number 2, it's going to have this as your balance. It's going to say your balance is now $249,945.83, and your payment is still $1,200. And we're just basically working that same math that we just did, but now off of that new balance. So to go through and do this, again, we're going to do these 1, 2, 3 steps. So step number 1, and again, we're just doing this all over, starting right there from the beginning again, but now bringing in our new balance. And our new balance, again, $249,945.83. Don't drop off the 83 cents. That is important. We're going to go ahead and multiply that by 0.055, which is 5.5% as a decimal, and then divide that number by 12. Excuse the lopsidedness of my writing there. But when we calculate that all out, that's going to give us our interest for month number 2. And in month number 2, let's see how this number is changing. It should be going down here. This number should always go down. If it doesn't go down, you have one of two things. If this is an exam question, you don't ever see negative amortization, so you did something wrong. But in the real world, what that means if your interest is going up, it means you've got negative amortization, meaning that let's say the interest calculation is $1,300 of the $1,200 payment, which usually doesn't exist, but maybe with an adjustable rate mortgage, that could occur. So this gets a lot very complicated, very easy. And we're not even talking about the very nitty-gritty complicated parts. We're just talking about the bare simplistic stuff this here of understanding this concept of amortization. So if we take this $249,945.83, multiply that by 5.5% interest, and divide that by 12, we end up with almost the same thing, but that decrease is still there. It's a very slight decrease, but it is still there. Even if it only goes down by this little of an amount, it should still be going down. And what our month 2 interest is $1,145. But like I said, the cents are also important as well. It's not 83 cents anymore. It's about 59 cents if we do some proper rounding there. So it did go down. It's not a significant decrease, but it did go down. So what that means, again, if we're trying to talk to our buyer, hey, you know that $1,200 you got to pay a month, a big portion of that's going to be tax deductible. This is how much is deductible the first month. This is how much deductible the second month. And again, you could Google amortization calculator in the real world. It's going to break you down this for the entire time, and you could say, okay, this is going to be this year how much you're paying in interest, and that's going to be tax deductible. This year, this is going to be how much you pay in interest, and that's also tax deductible, and so on and so forth. In the first few years, usually the time that most people live in their property of 5 to 7 years, it's probably not going to dip below $1,000 in interest it is that you're paying over the first 5 years in this scenario. I'm speculating here. Maybe it does. Maybe you get close to that, but it's probably not going to dip below $1,000 you're paying in interest. When you get, because this goes on, remember, for 30 years. When you get to 30 years, that's where this is going to flip around, and $54, that'll maybe be the interest, and the $1,145 will be the principal. So that's where it's going to go the other direction when you get close to 30 years out, but most people don't own their home for 30 years. On average, according to the National Association of Realtors, they're buying and selling their home on average every 5 to 7 years. So it might kind of seem like a bad thing that, oh, you're paying all this interest just to go buy another home and then be paying all that interest again. You're barely paying down your balance. Yeah, that kind of does suck, but it's tax deductible, so it really doesn't suck too bad, at least if you're making enough income for that deductibility to make sense. So let's now go into step number 2 and find out what our principal is. So just like we did in the first part of this here, we're going to take our payment amount, and remember, our payment amount does not change. It's still going to be $1,200. Still going to be $1,200, and now what we're going to do is bring down this $11.45. We're going to subtract out that same $11.45 and now 59 cents, and that's going to give us our month 2 principal. Our principal payment for month number 2 of $1,200 minus $11.45 and 59 cents gives us $54.41. So yes, again, it did still go up. So that would give us $54.41. So it checks out again. Our principal amount did go up. It wasn't a huge amount. It only went up by a few pennies. It went from 17 cents to 41 cents, but it still did go up. And our interest still did go down by that same amount. So remember, the interest is the driver of all this. You find out the interest first, and now what's left over is your actual principal payment. And let's just go ahead and finish this out, round this out with our very last step here of finding out what our new balance is for month number 2, our ending balance for month number 2. What we're going to do now, again, carry down that loan balance, that $249,945.83. That's what we started the month with. And now we subtract out what we just paid down for this current month, which was $54.41. So now with our handy-dandy calculator, taking $249,945.83 and subtracting out $54.41, we're going to end up with our month 2 ending balance, aka our month 3 starting balance of $249,891.42. So that's where we're ending out at month number 2 and starting month number 3. And that's amortization. It's basically just repeating that process. If you're able to do what we just did there, you can do that for 3 months, for 4 months, for 5 months, for 10 months, 12 months, or 360 months for a full 30-year mortgage. So that's the math that you're doing there. It's not complex math. It's really 3 core segments. Number 1, finding the interest, which you take whatever the current loan balance is. We started here, and then in month number 2, we had a slightly smaller loan balance. And in month number 3, it's a slightly smaller loan balance again. We take that loan balance, whatever the current balance is, multiply by the APR. Remember, that's an annual percentage rate. That's the thing that gets most often forgotten here, because if you don't divide that by 12, you're ending up with like $13,000. But that's the interest annually. We're breaking this down into monthly, so we divide that by 12, and we get $11.45.83. We then subtract that from whatever our mortgage payment was, and that gives us our principal payment, which is how much we decrease our loan balance that we started off with. We take that same balance we started with, subtract our payment, that gives us our new balance. And we did the whole same thing down here in a little bit more condensed manner because we're running out of space, but same exact steps that we just did. We're taking now that new balance, our current balance, again, multiplying by the same interest rate, dividing it by that same number of months in a year. That's not changing. That all holds constant. Really, the only thing that's going to be changing is what we're inputting in each one of these series of steps, is that balance, that starting balance. The outputs, what we're getting here, the principal and interest payments and our new balance that we're ending with, those are going to be different. But the only thing different that we're putting into this is what our new balance was, and that was our balance that we had paid off to based on the previous month. So that's amortization. Like I said, this is very likely to show up on your exam, probably at least about 2 months out. They might ask you for 3 months. You might have to go an additional month out like that there. But that's really it in a nutshell. You have to remember, in case you're dealing with taxes and insurance, remember, take that out of the equation so you're only dealing with principal and interest of $1,200. But that's mortgage amortization. And again, in the real world, this is helpful for you to understand, okay, how much the interest is and let your clients know how much is deductible. The calculators that are out there that could calculate this, they'll do it a lot faster than you. It's like in the blink of an eye, they figure out all this here, but it really helps for you to understand how it is that they're coming up with these numbers. In case you get that question from your client, because you're probably going to be pretty hesitant to show this to them when you say, oh, look, here's the calculations for amortization. Well, I don't understand this. How come we're paying so much for interest? And if you could quickly break down just even that first step, it'll make a little bit more sense to them. They'll be a little bit more understanding, okay, and then you talk to them about how that's tax deductible, and they're like, okay, well, sign me up for that. So this is very helpful to know. Financing is what makes the purchase of so many homes possible. Most people wouldn't be able to buy a home if it weren't for the mortgage financing that we have today. So it's a big part of the real estate sales process. And again, you being the executive overseeing everything in the transaction, you're there to have a basic understanding of everything that's going on, so that way you're able to keep the deal together. So that's all I've got for you guys today. If you want more videos to help you plan for your success, go to tampaschool.com/success, SUCCESS, tampaschool.com/success. We've got all of our previous episodes of Ask the Instructor, all of our previous episodes of State of Real Estate, a lot of great articles and calculators and all kinds of things to help you plan for your success in the real estate industry. If you don't have your real estate license yet, make sure you check out tampaschool.com. We've got not only great classroom and online courses, we've also got a strategy to help you pass your exams on the first try that really kind of hones in on the topics it is that you need to know. That whole strategy available is at passfirsttry.com. You'll see that right below, passfirsttry.com. So make sure you check that out. It's our recommended strategy to pass your class and state exams on the first try. A lot of great stuff on there, so definitely check that out. If you have any questions about anything or need any guidance of anything, give us a call. Phone number is 813-928-0106. You can also text us. Again, that phone number is 813-928-0106. Our advisors are standing by to answer any questions you have and assist you in any way it is that they can. So thank you guys for tuning in today. Make sure you subscribe so you don't miss any of the future episodes, and I will see you Friday for State of Real Estate.
Do you want to incorporate studying for your real estate exams into your busy schedule? Now you can review the key topics you need to know to pass your class and state exams with our MP3 audio review. Simply pop in your headphones or connect to your car to reinforce crucial information while you exercise or drive. Listen to the first unit for free at mp3audioreview.com. That's mp3audioreview.com. Does your current career allow for unlimited income potential? With a career in real estate, the sky is the limit. What you put in is what you get out. Find out more about how you can tap into the unlimited income potential of a career in real estate at tampaschool.com.
Hey, if you're enjoying the show today, which I'm sure you are, be sure to hit like, subscribe, post your comments, share with your friends and family. Thank you guys so much for watching.
You are watching
Ask the Instructor. Every Wednesday at 12 noon Eastern Time. I'm John Charismo. You're watching Ask the Instructor.